Ladies and gentlemen, this just happened, and you need to understand why it matters. This was not normal price movement. This was not a slow trend. This was a sudden shock to the market. When the futures market opened on Sunday night, silver jumped sharply within minutes. This happened on Globex, the overnight electronic trading system used by large institutions, foreign buyers, and automated trading programs. This is not where small retail traders usually trade. Moves like this do not happen by accident. When a market jumps hard during thin trading hours, it tells us one thing very clearly. Someone needed silver immediately. They were willing to pay higher prices right away instead of waiting. That is a sign of urgency. Most silver trading today is done with paper contracts, not real metal. Very few of those contracts ever end in physical delivery. But when prices jump like this during off hours, it suggests the paper market is losing control over the real, physical market. Here is why that matters. For more than a year, the amount of silver available for delivery on the futures exchange has been near record lows. At the same time, the number of open contracts remains high. That means many more promises exist than actual metal ready to be delivered. At the retail level, the story is the same. Physical silver is hard to find. Premiums on coins and bars remain high. Dealers struggle to get supply. Mints are delayed on orders. And then, suddenly, on a quiet Sunday night when most people are not watching, silver explodes higher. Ask yourself this: if silver were truly abundant, if supply were easy, if it were just another industrial metal, would it behave like this? This kind of move tells us the market is under stress. It tells us the paper price and the physical reality are starting to separate. Silver is not plentiful, and the system that has kept prices controlled for years is showing cracks. For decades, the extra supply of silver acted like a buffer. That buffer is now gone. Industrial use has been consuming more silver than mines can produce year after year. The difference was covered by above-ground stockpiles. Those stockpiles have been steadily drained. Now add what is happening today. Solar panel production is accelerating. Electric vehicle manufacturing is expanding. 5G infrastructure is being built worldwide. Military and defense systems are using silver at record levels. This is not a future shortage. The deficit is happening right now. Now let's look at the price action. For the past week, silver was moving sideways in a tight range. It was building pressure, like a spring being compressed. Technical traders were watching one key level. A clean break higher with strong volume would have confirmed a normal breakout. Instead, silver exploded higher overnight. That is not a normal breakout. That kind of move usually means one of three things: short sellers were forced to cover, supply suddenly disappeared, or a large institutional buyer stepped in and demanded immediate exposure. And when moves like this happen outside regular trading hours, it often means the real move has not even started yet. It tells us the market structure is under stress. Here is why Globex matters. During normal trading hours, large banks and market makers provide liquidity. They step in to smooth price moves. They absorb buying and selling pressure. They keep markets orderly. But during overnight Globex trading, liquidity is much thinner. Fewer participants are willing to take the other side of a trade. So when the large buy order hits the market, there may not be enough sellers at the current price. The market has no choice but to jump higher until sellers appear. That is exactly what happened. At those prices, there simply were not enough sellers willing to sell silver. Buyers had to chase the price higher. Think about what that means. Silver is already near historic highs, yet buyers are still desperate to get in. And if this is happening in the futures market, where most contracts never result in physical delivery, imagine the pressure in the real physical market. That is where manufacturers, governments, and large holders are competing for actual metal. Now connect this to the global picture. China has been restricting exports of critical materials for months. Antimony exports are limited. Gallium and germanium shipments have been cut back. Strategic resources are being weaponized. Nothing is happening by accident. This is supply stress meeting global demand, and the silver market is starting to show it. There are now open discussions about possible silver export restrictions from China. China understands something very important. Silver is not just a precious metal. It is a strategic material. It is essential for modern technology, defense systems, and energy infrastructure. China is both a major producer of silver and the largest consumer in the world. If China decides to limit exports or keep more silver inside its own borders, the rest of the world would face an immediate supply problem. At the same time, the United States is bringing manufacturing back home. This is happening under pressure from both political parties. Tariffs on Chinese goods are not going away. The CHIPS Act is pushing billions of dollars into domestic semiconductor production. The Inflation Reduction Act is heavily subsidizing solar panels and electric vehicles built in the US. Every one of these industries uses large amounts of silver. But the supply chains to support this demand are not fully built yet. So what do you have? You have demand surging because of government policy. And you have supply tightening because of geopolitics. That combination is exactly how sudden price shocks happen. Now, let me give you the downside risks. Because this is not about hype. Volatility works both ways. A sharp move higher during thin overnight trading can reverse just as fast if the buying was temporary, or if traders take profits when the main market opens. Prices can pull back quickly. We have seen this before. Sudden spikes that are sold off within hours. That is the first risk. This move may not hold. Price could fall back to previous support levels, or even lower if stop losses are triggered. The second risk is intervention. Not direct selling by central banks, but action through large commercial banks. If a strong rally threatens big short positions, these banks have tools to slow or suppress price moves. That can include heavy futures selling, negative media coverage, or rule changes that make trading more difficult. We have seen this playbook before. In 2011, when silver surged toward $50, margin requirements were raised multiple times in a short period. Leveraged traders were forced to sell, and the price collapsed. The third risk is a broader liquidity shock. If financial markets seize up, if there is a credit crisis, or if investors are forced to raise cash quickly, even strong assets can be sold to meet margin calls. In moments like that, price does not reflect value. It reflects stress. When markets suddenly shift into risk-off mode, everything can get sold at once. Silver is not immune to that. Even if the long-term story is strong, silver can drop hard during the initial panic. We learned that lesson in early 2020. In just 2 weeks, silver fell sharply as leveraged traders were forced to sell anything they could to raise cash. It was not because silver was weak. It was because margin calls forced selling across the board. In a true liquidity crisis, correlations go to 1. Almost everything gets sold. Only cash and government bonds tend to hold up. That does not break the silver thesis. It simply explains short-term volatility. Now here is what the bearish scenarios do not change. According to the Silver Institute's latest data, the market has been running annual supply deficits of roughly 100 million ounces. When you add up all demand, industrial use, solar panels, jewelry, silverware, and investment demand, and compare it to total mine supply and recycling, the gap has to be filled from existing stockpiles. Those stockpiles are not unlimited. Every year the deficit continues, the buffer gets smaller. And when that buffer is finally gone, price does not rise slowly, it jumps suddenly. Why? Because industrial users cannot stop production. A factory cannot shut down a solar line or electronics assembly because silver is missing. They will pay whatever price is required to secure supply. Now here is the key reframing. That sudden spike on Globex was not just a price move. It was a signal. It was the market telling you that the paper pricing system is under strain. For decades, silver prices have been set mainly through futures trading on exchanges where most participants never take physical delivery. They trade contracts, not metal. But what happens when real buyers start demanding delivery in large amounts? What happens when the metal available for delivery is not enough? You get backwardation. That means silver for immediate delivery becomes more expensive than silver promised for the future. This is unusual. In normal markets, future prices are higher because of storage, insurance, and financing costs. But when physical supply is tight and buyers need metal now, that structure flips. And we have already started to see this happen, briefly, at different points in the silver market. That is not noise. That is stress. Over the past year, we have seen short periods where silver behaved strangely. Prices for immediate delivery briefly rose above future prices. Each time, it was brushed off as a one-time event. But when the same thing keeps happening, it is no longer an anomaly. It points to a deeper problem. What you saw tonight on Globex could be an early warning. It could mean large buyers are realizing that waiting is risky because metal may not be available later. It could mean governments are quietly building strategic stockpiles before export restrictions are announced. It could mean industrial users are panic buying to protect their supply chains. Or it could be all of these things happening at once. What matters is this. This was not retail speculation. This was not social media hype. This was institutional urgency in a market that is supposed to be calm and liquid. Now here is where the setup becomes important. The commitment of traders report tracks who holds positions in the futures market. For months, it has shown that commercial players, mainly large banks, hold sizable short positions in silver. These shorts are supposed to hedge physical inventory or production. But the size and concentration of those positions, held by only a few banks, has raised serious concerns. This is not theory. In 2020, JP Morgan paid nearly $1 billion in fines for manipulating precious metals markets. That was a legal settlement. If those short positions are now under pressure after tonight's move, the banks face a choice. They can buy back contracts to close their shorts, which would push prices even higher. Or they can add more shorts to try to control the price, which increases their risk if the rally continues. Either way, the setup is uneven. The upside, if physical supply separates from paper pricing, could be very large. The downside, if price is pushed lower again, is likely a return to recent support levels, especially if broader markets sell off. From a risk-reward perspective, that matters. Now let's add historical context. This is not the first time silver has moved like this. In the late 1970s, silver rose rapidly when large buyers accumulated physical metal and demanded delivery. That pressure created a massive short squeeze. Eventually, the exchange stepped in and changed the rules, raising margin requirements and limiting positions to stop the move. The lesson is not that silver cannot rise. The lesson is that when physical demand overwhelms paper supply, the system reacts. And that is exactly the tension building in the market today. The price eventually collapsed back then. But here is the key difference. In that earlier episode, the buying was concentrated in a small group that regulators could clearly identify and target. Today, buying is spread out. It is coming from governments, industrial users, long-term holders, and institutions. You cannot change the rules to stop countries from building reserves or companies from expanding factories. That makes this situation very different. There is another comparison worth mentioning. In 2011, silver reached nearly $50 before falling for years. What stopped that rally? Higher margin requirements, easing stress in Europe, and massive money printing that pushed investors back into risk assets. Could something like that happen again? Yes, if central banks manage to calm inflation without causing a recession, stabilize debt, and restore confidence in paper currencies. But given today's debt levels, ongoing deficits, and rising geopolitical tension, that outcome looks unlikely. Now here are the three key takeaways from tonight. First, the overnight spike was not random volatility. It was a sign of real supply tightness colliding with a paper market system built for a different era. Second, the risks are real. Volatility will remain high. Anyone holding silver needs to be ready for pullbacks, false moves, and emotional pressure that comes with the territory. But the long-term direction is driven by fundamentals that cannot be ignored. Third, The paper market and the physical market are drifting apart. When that gap becomes too wide, it tends to close suddenly and violently. Here is the unresolved question. We do not know if this move holds when regular trading opens. We do not know if this was a one-time spike or the start of something bigger. We do not know how major banks will respond. What we do know is this: the setup has rarely been this one-sided. The fundamentals have rarely been this strong, and the gap between paper pricing and physical reality has rarely been this large. So verify everything for yourself. Check the data. Watch inventory levels. Monitor premiums. Follow global developments. Make decisions based on facts, not fear or hype. This is your capital, your future, your responsibility. Stay rational. Stay informed. Log out.